IMF just out with a new report on the U.S. economy, urging the Fed to stay hawkish in its fight against inflation. IMF Managing Director Kristalina Georgieva just wrapped up a press conference on this very report, and she joins us now in a first on CNBC exclusive interview with our very own Sarah Eisen. Welcome to both of you. Sarah.
Hi, Kelly. Thank you. And Managing Director Kristalina Georgieva, thank you so much for joining us this afternoon first.
Great to be with you, Sarah.
So I'm going through the report, hot off the press. Feels like one big headline here is that you say the U.S. will manage to avoid recession. And I'm just curious how you get to that conclusion, given all of the tightening we've had so far from the Fed.
Well, what we have seen from the data is that consumer demand is resilient. It is now being boosted by what comes from the strong labor market, and it is increase in incomes. This is, of course, excellent for households, and this is the foundation on which we project fourth quarter to fourth quarter growth in 23 of 1.2%. And we expect this growth momentum to continue in 24, provided risks are well managed. Now, the flip side of this positive story is that inflation is stubborn. Yep. It is way too high vis-a-vis the Fed's target. And that, in our view, means that the Fed will have to keep interest rates higher for longer, all the way into 2024. We think that interest rates around 5.25% to 5.5% is what would be needed to cool down inflation and put it on the desired track to target.
So it sounds like not only do you recommend those rates stay high for longer, but it sounds like you think they're not done raising rates, that there's more work to do here?
Well, that is what we see, that the picture, including what we got today in PCE data, is that it might be necessary to get a notch higher and then stay a little longer than we initially projected to bring inflation down. What you should also pay attention to is that our projection for unemployment is that it would go slowly up to 4.5%. 4.5% unemployment is still a very strong labor market. And that is why we come up with this duality of messaging. One, growth is good. Two, inflation is not. It needs rates to stay higher for longer.
Your view on the Fed path is a little bit different than the markets. And in part, the market sees inflation coming down faster. And what we're getting from some of these companies, Costco was the latest last night, is that it is moderating sharply. Even the housing companies talk about house prices coming down, and then there's the worry about the bank stress and the impact of credit tightening. So all of that is to say that the market appears more worried about over-tightening than under-tightening, and you appear to be worried about the opposite.
Well, I would be thrilled if the markets are right. But so far, they have gone into this expectation that we won the fight against inflation a couple of times, and that has not really quite happened yet. And what we are looking into is the strength of consumer demand fueled by two things. One, the fact that we have some increase in income, and so the pent-up demand from COVID may be exhausted, but there is a new fuel coming from the tight labor markets and how they impact wages. And two, while we're seeing some cooling of the property market, because majority of current homeowners have rates that are fixed, this is not pushing down consumer demand as it would have done if we were in a world of flexible rates.